This is the Town of Moraga Audit and Finance Committee for Monday, December 2nd, 2024. It's 5:07, and I'm calling the meeting to order. Roll call. Mayor Onata.
Present.
Vice Mayor Wallachie.
Present.
Here's the list.
And Treasurer Kennedy is here. The other two members are not here.
Okay.
The next item on the agenda is public comments and suggestions. This is time reserved for those in the audience who wish to address the Audit and Finance Committee on items that are not on the agenda. The audience should be aware that the committee cannot discuss details or vote on non-agenda items. Your concerns will be referred to staff or placed on a future agenda. Note public input is also taken at each agenda item. Is there any public comment? Seeing none, I'll close the public comment. Next item is approval of our action minutes for the AFC meeting of June 17th, 2024. Do I have a motion?
Move for approval.
Second.
Any discussion?
Looks good.
If not, all in favor?
Aye.
Aye. Opposed? None. Therefore, they pass unanimously. The next item is review of audited financial reports for the year ended June 30th, 2024.
All right. Good evening. Good evening, Chair Kennedy and Mayor Onata and Vice Mayor Wallachie. I'm Katie Bruner, the Administrative Services Director, and tonight we have Vicki from our auditor firms, Mays & Associates, providing an overview of our audited comprehensive financial report for fiscal year ending June 30th, 2024.
Okay, I think it is on. Okay, well, thank you very much for having me present this evening. Very nice to see all of you. Will you be putting it up or, sorry. So I'll be presenting, so there are 4 reports that I'm presenting this evening. These are the final drafts of the annual comprehensive financial report, or just because that's a lot to say, we call it an ACFR, and that's for fiscal year ended June 30, 2024. Along with that, we have the Memorandum on Internal Control and Required Communications. And then we have also issued the agreed upon procedures over the calculation of the appropriations limit. So those are the 4 reports that we have provided. So I will begin the presentation. So again, I'm Vicki Rodriguez. I am the engagement partner from Mays & Associates, so I am in charge of the audit. So just to provide a little bit of background, just the requirement. So the town does have an ordinance related to oversight, annual audit, and public report. And so annually, the town council retains an independent auditor to conduct an audit of and provide audited financial statements for all of the town's financial activities. So who we are, Mays & Associates. We've been in business since 1979. We are a municipal auditor. We only work with municipal government and local nonprofits. And we've been a municipal auditor since 1987. We audit over 150 municipal entities. That includes over 50 cities and towns, and we issue over 40 ACFRs. And most importantly, we are independent from the town. So the annual audit, the services that we've been engaged to perform is the audit of the town's financial statements for fiscal year ended June 30, 2024, the agreed upon procedures over the appropriation limit calculation, as well as a compliance audit of federal awards, a single audit. That portion has not yet been completed. That's not due until March 31st of next year, so we will be returning to conduct that piece of work. We conduct our audit under auditing standards generally accepted in the United States of America, as well as government auditing standards. So that's a higher level of auditing standards required because you do receive federal awards. So the audit timing this year, we conducted the interim phase back in June. That's where we come in to get an understanding of the internal control environment. We verify that the controls exist. We perform control tests. This is where we're testing different accounting cycles, sampling transactions, looking at backup, looking at reconciliations, and just making sure that there's proper segregation of duties or just mitigating controls in case there are any conflicts. With a small staff, you will have minimal people to do everything, and so they have to be creative in order to make sure that there are checks and balances. And so that's the time when we come in to review that piece. We perform the final phase in October. That's when we come back. That's when finance has closed its trial balance, provided that to us. We test the financial balances. We perform analytical. We test, significant, large, or unusual transactions, as well as reviewing actuaries from your pension actuary, your claims liabilities, looking at legal letters, loss runs, and such. And this is also when we work with town staff to prepare the financial statements and the footnotes. So the results of the audit is that we are issuing unmodified opinions for all of our different opinion units. Unmodified is the cleanest opinion that the town can receive. It's the highest level of assurance that I can provide you. So congratulations for that. And we also, for the appropriation limit calculation, we did not note any exceptions related to that calculation. So again, clean report. So I'll go over the annual comprehensive financial report, just kind of a high-level overview, and then we can, but please feel free to ask questions along the way. So the different components of the ACFR, so for just a basic financial statement, because the town's not required to issue an ACFR, they do have to issue a basic financial statement. And so what that includes is the auditor's opinion, the management's discussion and analysis, as well as the statements and footnotes. What the ACFR also provides is a transmittal letter that's written by town management, required supplemental information, so that's 10-year data for example, for your pension plans, as well as more budget actual statements. And we also include combining statements for all of the different funds and the statistical section. So that provides a lot of really good information of historic values, numbers, and demographics. So last year, for fiscal year ended June 30, 2023, the town did submit the ACFR to the Government Finance Officer Association, or GFOA, and did receive the Award of Excellence on Financial Reporting for that ACFR. The town, again, will submit its June 30, 2024 ACFR, and we have no reason to believe that they won't receive the award. ACFR, that's the Annual Comprehensive Financial Report. So that's just the whole name of the entire financial statement. So we just say ACFR just because it's a lot shorter. We love acronyms. It's okay, so entity-wide versus fund financial statements. So you'll notice in the financial report that you do have entity-wide or town-wide statements. That's the statement of net position as well as the statement of activities. And so that includes all of the town's activities all combined together, and includes not only the current assets and current liabilities, it also includes the long-term assets, so like your capital assets, as well as your long-term liabilities, so any long-term debt, subscription-based agreements, claims liabilities. So the townwide or entity-wide consolidates all of the financial activities together. And the equity portion of those financial statements is called net position. For the fund level, this is more of a budgetary-based financial statement. So this is where you're looking kind of shorter term. The fund level includes current assets and current liabilities. And then the equity portion is called fund balance. And the fund level is also broken out by different activities. So you have your general fund, and then you have other funds from different revenue sources or capital improvement projects or debt service. This year, there was one accounting pronouncement that was implemented. This is GASB 100, accounting for changes and error corrections. And so what the objective of this statement was basically just to enhance the accounting for any corrections or errors. Or I guess corrections, errors, as well as any accounting changes. We've had a lot of accounting changes over the last few years, and so this is to try to make things more transparent, to have more of a template for footnotes and descriptions, and hopefully make it more understandable to readers. This is an ongoing requirement, so it was implemented this year, but any year in which case the town has any corrections or accounting changes, this GASB statement will apply for that year.
This would be corrections that were, let's say, to a prior year.
Like a restatement or a reclassification, prior period adjustment, yes. But it could also be like if you do have a new accounting pronouncement or a change in your method of accounting, this also applies to those as well. So the impact for June 30, 24, so there were a couple of impacts related to this. So in this year's report, so now if a fund used to be a major fund and now becomes a non-major fund, and that's usually, it's based on a calculation. Major funds are funds that have significant assets or significant liabilities in comparison with the town's activities. So some years, a fund may be major and then it may be non-major. So there is more transparency of that. For this year, the ARPA, or the American Rescue Plan Act, that fund was major last year because of the revenues received. This year, the activity is minimal, so now it's non-major. And so there is a disclosure, and you can see the fund actually moving from major to non-major. In addition, last year there was an other capital projects fund that was a major fund. So this year, Finance did recategorize that into actually special revenue funds. It's more appropriate to call them special revenue funds because of their revenue sources. And so that now those are actually individual funds. So I think it was like one fund last year, and then now it's 7, I think it was 7 or 9 funds that are now reported into non-major funds. So those were the two kind of significant movements of funds. Also, there was a restatement in the general fund combining, and this was a movement of $1,500,000 from the developer fund to the general purpose. But the overall fund balance of the general fund was not restated. So this was just a movement between your combining activities. So I think those were the overall impacts from this GASB.
Can I ask you, was that 1.5, was that Apollos money that moved to general?
Yes, I believe so. Yeah.
Yes, it was the $1.5 million from the Palos Fund that town council set aside in the pension trust.
That's right.
So we
Okay.
so that was adjusted there, and then actually also in this year, we moved the pension trust into its own separate internal service fund to record the activities and the interest that the pension trust earns in a separate fund from the general fund as well, so.
Thank you. I saw that, and I was just thinking, I bet that's that. So
Okay, so the town-wide, so again, this is the consolidated, considering long-term activities. Your total assets is 108.2 million. This includes your cash and investments as well as your capital assets. This is an increase of about 2.7 million from last year. That's a 2.5% increase. The deferred outflows, those are related to pension. So those include things like contributions made after the measurement date. The measurement date is June 30, 2023, but during the year, contributions were made to the plan. The bulk of that, those deferred outflows includes those contributions. That's pretty similar to last year's balance. Liabilities are 17.1 million. The liabilities includes your certificates of participation, your net pension liability, your subscription-based information technology arrangements. That's down about 100,000 this year, which is about 0.5%. And then your deferred inflows are related to the leases, as well as pension factors. And then your overall net position, which is basically your assets, plus your deferred outflows, less your liabilities, less your deferred inflows. So your net position was 91 million.
So, question, just confirming, that's equivalent to net worth of the town?
Mm-hmm. Yes. Yeah, so net retained earnings, you'll hear retained earnings, fund balance, net position, net assets.
Thank you.
Mm-hmm. And then just to, because net pension liability, always just to highlight that, the net pension liability did increase by about 778,000 this year, which is a lot better than last year. So, but it's finally smoothing. We've had a few years of it really being kind of this roller coaster ride. So I feel like it's kind of getting back to smoothing, at least for now. All right. So then your net position is made up of 3 different components. So you have your net investment in capital assets, which is about 80% of your total. That's basically your capital assets less any debt related to those capital assets. And then restricted, those are outside legal restrictions. That's about 8% of your net position. And then your unrestricted makes up about 12%. And so the balances, here's a comparison between 2023 and 2024. So your net investment in capital assets increased by 1 million to 72.9 million. Your restricted increased about 0.8 million to 6.8 million. And then your unrestricted increased about 1.9 million. So overall, it's a $3.6 million increase from prior year. Just to provide some highlights on the general fund, so your fund balance increased 112,000, or I'm sorry, decreased 112,000 to 11.1 million. The different components of that fund balance, so you have your non-spendable amounts, which is mostly your prepaid items, so that's 46,000. Your restricted portion is about 16,000, that's for deposits. You have 2.8 million in committed related to the developer fees, and then your unassigned, which is basically everything else, is 8.3 million. Did you have a question or?
Yes. Since we have the 8.3 up there right now, our metric, minimum metric is 50% of our operating budget, and the report shows the 8.3 at significantly above that. Historically, we've been around 50%, and this is quite a big increase. I guess the question I have is, what are the ramifications of that, and is that something to worry about or be happy with? Historically, we kind of manage it around 50%.
So in our in fiscal year 2023, that's when the town funded its pension trust, and we used Colorado's funds to fund the pension trust. And in our, when we closed out the year, essentially because both our Palos funds and our general purpose fund are presented combined in a combining general fund statement, those transfers in and out get reclassified and don't show. So we, that was part of the restatement or the movement between the Palos funds and the general purpose fund. It was, so that actually, I would say last year, our general purpose fund balance, unassigned fund balance was understated, and our restricted fund balance was overstated. So we corrected that this year, and then to avoid that happening in future years, we also moved the pension trust into its own separate fund to make it very clear what funds are restricted for the pension trust versus unassigned. So this is higher. It's a couple of it is higher than previous. I think we will be, when we come back at mid-year, there will be a recommendation on an action of how to bring that in line with the 50%. The current policy is to put anything over that into the asset replacement fund.
Right.
But I think this is also an opportunity to look at, are there, other strategic areas to use that fund balance in.
Katie, did I understand you to say that shifting of that 1.5 million restricted pension trust is a contributor to increasing that ratio? And therefore, if that's the case, don't we want to somehow pull that out, exclude it, so that we don't think that we're in good shape, and when we really have that money is really restricted?
So that's what we did, is that pension trust is now in its own separate fund. So it's not included in the general fund. It's now in a proprietary fund, an internal service fund. So it is totally separate from our general fund. So we don't count it as restricted or so we don't, when we're looking at our total general fund net position, the pension trust is outside of that, because it is held in reserve specifically for pension costs.
So are you saying that in terms of the metric of 50%, even though this says unassigned, we're really not comparing that 50% basis the 8.3 million?
No, the 8.3 million is compared to our reserve policy is 50% of our general fund operating expenditures.
Right.
When we made that, the transfers in and out between the general fund are not, they're reported in the ACFR, they're not part of the operating expenses, so we don't look at our transfers in and out. And so it's really looking at, it's how we, from the prior year to this year, when we had the general, I'm trying to explain this. I feel like I need a whiteboard here. So if you look at our prior year financial statements for the developer fees, that balance was actually I'm doing math on the fly, which is never a good 2.8 plus 1.5. It was about $4.3 million.
Is there a page that we could look at that would make it this?
Yeah, so if you look at page 82, which is our general fund combining balance sheets. So last year, fiscal year 23, our developer fees was about $4.3 million, and all of that was committed. And in the general fund, we had just over $1.5 million, that pension trust contribution, which actually came from developer fees, was included in the restricted. And so but it was really funded by developer fees. But over the past 2 years, we've actually had higher revenues than budgeted and lower expenditures than budgeted, which then increases our contribution to the general fund unassigned fund balance. And so by removing the pension trust into its own separate fund category helps more accurately capture and reflect the difference between our true operating revenues and our true operating expenditures.
So on page 82, the general purpose fund, that 8,200 and, or 8,339 or what, what's the number that we use to figure out the 50%?
If you go to page 83, so 8,293,284, our unassigned fund balance on page 82, that's our reserve balance. And then if you go on page 83, the next page, we look at our total expenditures in the general purpose fund, and that is 11,087,26. And so we take 50% of the $11,087,000, and we calculate 50% of that, and that is our minimum reserve level for funding.
So should we be considering transferring the delta between, 50% of it's about, 5.5 million versus 8.3 million? Should we be really considering moving that difference into asset replacement?
Correct.
Yeah, I was gonna
somehow-
say, it is a good problem to have. It's not something
Well,
that
I
you know,
think
but
last year we were at about 55%.
We are,
And somehow we went,
We went up about $2 to $3 million.
and actually, if you look on page 83, there's a correction of error asterisk. And that shows the movement of the 1.5 million between
1.5.
Palos and the general purpose. So that's really what we're seeing here is we had that actually happened last year. We probably would be having this conversation about the reserve levels this time last year, but we, it was a,
so then, but for consideration of potential moving,
Yes.
shouldn't we back out the 1.5 million?
no, that's already been moved and taken into consideration.
that was, yeah.
To
that
me,
was
this
paid
looks
to
like
the
it's been
trust.
added
That
into
was
it.
already paid to the
That was
trust.
paid to the trust, the 1.5 million. It's just you're paying back general fund,
Because we use
for that.
Palos funds for the pension trust.
Okay, so it sounds like we're going to have a subsequent conversation at some point with regard to
Yes.
what we're going to do with our windfall.
Yes, so per current policy right now, that anything above that 50% would go to asset replacement. And when we look at that conversation, as far as I'm aware, typically comes with our mid-year where we get that actual action. But because it is such a large amount, there may be a discussion with the council or the, recommendations from the AFC about if putting all of it towards asset replacement is the correct move. But
Well,
current policy says that's what we would do.
hopefully we'll defer to staff recommendation on that.
And can you tell me exactly how much we are over that 50%?
Well, it's,
The 50%.
That would go to
So the
asset replacement?
55% of our operating expenditures would be $5.5 million. And so we are over by
Wait, 55 or 50?
2.8.
5.5
About
million,
two-
I'm so
two-
sorry.
So it's 5.5 million?
Yes,
You-
so we have about, and change. So we have about $2.7 million over our 50% reserve requirement.
Thank you.
Thank you.
I still don't quite, or I really don't understand. I've never seen a year when the true number has jumped anywhere. A really good year would be our budgeted revenues and our budgeted expenses, we end up maybe being $600,000 or $700,000 better. This looks like it went from, because we were right around 50 last year, I think.
Yes.
50%. To go up 2.7 million is,
Well, and 1.5 million of that is because we truly used Palos funds for the pension trust, but they were reflected as coming from the general purpose fund last year. But if you look at our budget to actuals from last year, both fiscal year '23 and this current fiscal year, our revenues also came in higher than budget, than we expected, and we did have expenditure. We didn't fully expend our budgeted expenditures, and I'm trying to think of the page where we
Page
have.
31,
Yeah, I think you're right. So, yes, so page 31 does have our general purpose, our general fund budget compared to expenditures, budget and actuals. So revenues were budgeted at 10.7 million and came in $330,000 over budget. And then expenditures were 11.9 million was our final budget and came in $800,000 under budget. So that also contributes to, we would have $1.1 million increase in in general fund balance if without the pension trust movement. So
which is good news.
it is.
Yes.
Yes.
All right. Next.
Bob, I also remember like 70,000 it seemed to be the golden number instead of 2.7.
So other highlights from the report, so as we've talked about, so there was the establishment of the new internal service fund. That's for the section, oh, sorry.
Mr. Chair, could I say something? On the way we, what page was that, page 83? The way we show the reserve at 80, yeah, 50% reserve, how it's calculated is 5.5 million. I'm sure our consultant sees with other clients, that would be restricted. So we may have to change with next year how we label that. It's restricted by policy, not by law, but by policy. So even though it shows unassigned, I'm accustomed that when there's a formal reserve policy requirement, then you would show that as a restricted amount. So we will have to work on that. To the lay reader, it might seem like, oh, that's money that the council can decide.
Unfortunately, GASB doesn't allow it to be shown as restricted.
Yeah.
Because it's not an outside legal restriction, because it is.
Yeah, but we can make a note, we can make an explanation in the notes.
Which I believe there.
Yeah, we need to make it clear to the reader, the casual reader, that that's not free money. There's a policy, it's restricted, and to spend that money, we'd have to go to council. They would have to amend the policy or at least temporarily expend it or suspend it for an
Right.
emergency.
I mean, it is something that
Yeah.
does happen.
Yeah, you are right, and I sometimes date myself as a recovering finance director from many moons ago before all these GASB changes, and I'm accustomed to showing it as restricted, but we'll use the right language so we clarify that.
Yeah.
But it does look like you've got the developer fee, it's in a separate line, even though it's technically part of the general fund.
Yeah.
But it looks like there's another $1.2 million that the council next year needs to kind of figure out what they're going to, how they want to approach it.
You're correct, and one-time money, not recurring money, but right. I think Katie's going to look at further fine-tune how we calculate the 50% reserve. There's many, many ways to skin the cat in terms of what you use as your
In the
base.
past, we had not used the developer fund as a base for the, or that was not included, that was off to the side.
So we have to, with the developer fund gets, the Palos funds, it is a separate fund, but it is reported up in our general fund group. So we have a couple different funds in there. But the fund balance of the Palos fund, so the monies in there, are committed. They are committed fund balance, which means we do have to, they are set aside and restricted by council. So that is, they are not calculated in part of our unassigned fund balance, which is, so they are accounted for separately, and they're not accounted for in part of our meeting our reserve policy.
You're trying to balance between what GASB said and presenting it in a way that the council and the community, the town itself, looks at these things, and those don't always
No.
line up.
We try to reconcile the two as best we can, but sometimes there's.
Okay.
Okay. So the other highlights, so again, the Internal Service Fund was established. That's for the Section 115 Irrevocable Pension Trust. So the monies that are in the trust were moved from the general fund into this Internal Service Fund, for transparency as well as tracking the interest on its own so that it's not pulled with the rest of the town's funds. We talked about also the recategorization of the fund that was previously the other capital projects funds. Those have now been moved to individual special revenue funds. And then the other highlight is the issuance of the 2023 certificates of participation this year, which also paid off the 2013 COPs. So other than the ACFR, we also have the Memorandum on Internal Control and the required communications. The Memorandum on Internal Control is also known as a management letter, but this is where we would note if we had any, we noted or detected any control deficiencies, so any material weaknesses or significant deficiencies. Happy to note that we had none to report to you for fiscal year 24. Included in the Memorandum on Internal Control, we did include an other matters section. That's not a control deficiency, it's just information about upcoming GASB pronouncements. The required communications talks more about if there's any significant accounting changes or any issues during the audit process. So we do discuss the implementation of GASB 100. That's the one for the accounting errors and changes in accounting. We had no significant adjusting journal entries. So happy to report that. And also the audit process itself was very smooth. It was a very seamless transition, especially since you have a new administrative services director, but she's awesome. You guys are lucky.
Thank you for saying that through the chair.
Yes. No, it's always very nerve-wracking even for us anytime there's significant turnover like that. So, but this year, really kudos to Katie and Sylvia. It was a very seamless transition. They were very prepared for us, prepared early, met all the deadlines, and were very communicative with questions and everything throughout the process. So it was a very, very, very smooth process. And with that, any questions about the audit or any of the reports?
Vicki, thank you very much. Very clear, and it's great to see. A question, of your 150 different municipalities serviced by Maze, is it pretty standard that they receive the ratings of clean opinions and no exceptions?
I would say on audit opinions, it is pretty standard to have an unmodified opinion. What I would say, though, is that our management letter usually, I won't say that it's more often than not that there are material weaknesses or significant deficiencies, but we usually do have recommendations. So again, financial statements are usually, clean opinion, but we usually do have recommendations on internal controls or too many adjustments. Usually, again, in places where there is turnover, we often have quite a few adjustments after the closing. But again, here we really had no issues with that.
Good. Yeah, go ahead.
I've got one question that's kind of an odd question. So on page 132 of the report, it says in 2024 and 2023, under parks, we gained 2 acres. And I was wondering where that came from. We went from, 1 acre, I'm sorry. We came from 3 and under parks, and we ended up with 4, 23 and 24. And I was wondering about that.
Is it
Oh, it's the last,
is it possible it's
I
the,
think mine might be outdated, or
is it possible it's the annex? The,
The West Commons?
yeah.
That would have been a long time ago.
We'll have to follow up directly with the,
If it's one, maybe it's a rounding situation. Well, but I mean,
Yeah, maybe.
it could also be, I'm wondering,
I don't
we'll follow up with the departments and we'll
Yeah, I
get
just
back to you.
thought,
you're like, where's the new park, right?
Well, but didn't we more recently accept the West Commons Park?
I think
because-
that was a few years ago, though.
Well, because they had to fix the
The
trail. Walkway.
Yeah, but I think that still was a couple of years ago.
okay.
But maybe I'm wrong. And then I was thinking, well, maybe Mulholland is considered a park, and that would be adding one. But I don't know why that would be added in 2023. But anyway, that's the only thing I scratched my head about.
It could be a final map item, who knows? Yeah.
Or it could be they forgot to add it in the year, and then they're like, wait, we do have this other park. Yeah.
Whatever.
Chair, when we got time, I do have a few questions for staff. Okay. So we state in the report that we get 5.2% share of property tax dollars, and that's the lowest proportionally within Contra Costa. However, when I talk with associates from other municipalities, they indicate that, in fact, that breakout is not comparable between municipalities. For example, some municipalities, their higher percentage includes the cost of a fire.
Oh.
And so I'm wondering whether at some point we need to either rationalize that or maybe stop saying that we're the lowest in the county. It's just, maybe that's more semantics, but
maybe I can comment on that, because I went through and looked at the percentages for all 19 cities.
Wow.
And Moraga is the lowest. Hercules is close, but
Hercules is
we're
close.
lower. But you do need to be careful when you're comparing these, because Richmond, for instance, has they get a really high percentage.
Right.
But they have a fire department. And the 3 or 4 cities that have fire departments, they're going to have a much higher percentage.
okay.
And when you had redevelopment, that kind of tweaked the numbers. Now they probably,
I think Hercules may be one of them that includes the fire department.
I don't think Hercules,
Does?
I think
Nice.
there's
Anyway,
Richmond, El Cerrito, Pinole, I think, I can't remember.
fine. I defer to the chair and his assessment.
I just happened to have spent time looking at that one.
Yeah. Well, if we're going to do bragging rights to be the least funded, we should,
That's why I spent so much time looking at it, because
Okay.
I first of all couldn't believe it, and then I said, well, let's be sure.
Mr. Chair?
Oh.
For Vice Mayor Wolke, thank you for pointing that out. And I know, Mr. Kennedy, you spent a lot of time on this topic over the years. I've seen the historical documents, and when the town incorporated it, it knew it was going to have a small sliver of the AV.
Right.
It's a fact. I think the way it's worded, it does point out it's a fact. But you'll notice we've stopped making reference to this in a lot of our policy documents, like the budget message or even the beginning of the CAFRA. I don't think we point that out anymore. It just is a reality for Moraga, good, bad, or indifferent, and Steve's points are spot on. We don't have in-house fire and all that other stuff, and we make do with what we have, and it's, from a staff standpoint, it's not constructive to complain about it in public, out loud,
Right.
because the county would say, well, you knew that when you incorporated, right? But we've become very nimble. The voters did approve Measure K. Mr. Kennedy, you played a key role in getting the information out about that. So Steve, we're trying hard to just be more factual in an explanation on a chart like this, but not up front and not complain to the voters. It's not fair. So it's a very good point, and we appreciate it.
Very good, thank you. when we talk about the net pension liability, and it went up about $750,000 this year, and I know it varies, but that's a pretty big increase. But I guess it was more last year. And the question I have is, or the issue I have, is that we also have a goal to develop a long-term financial plan for the town, and I'm wondering, can we really do that when we have this UAL bouncing around and the annual costs associated with that increasing? And then when I look at the impact of interest in the report on that liability seems to be very sensitive to changes in interest rate, but that CalPERS achieves. Do we need to, I guess, list this as a risk as per the GASB 102, certain risks, and it may not, I don't know if it fits into that total definition, but it's concerning as to really how much risk we're taking on. Granted, we don't have control over it. We have no way to predict how it's all in CalPERS and the market's hands,
It is. I understand your risk. GASB 102 in determining what is a risk has some very specific criteria, and so that is something we will definitely take a look at as we implement that pronouncement. Also, we have to, with CalPERS, the rates of return that are incorporated into our current financial statements are a year behind. So they're 2 years behind. So we're always in catch-up mode. So the pension liabilities reflect a return, I think, of 5.7, 5.6%.
Right.
The returns as of June 30th this year, I think, were 9.2. So we should see some in the opposite effect and more of a smoothing. We do have tools to forecast our pension outlook as we look at a 10-year financial forecast. That is something we are definitely looking into. And I think your council has made smart moves in preparing for the future for when we do know those UAL costs are going to increase at a higher significant rate, with the pension trust to continue to help smooth those contributions that we are controlling, because we're controlling that investment portfolio outside of the CalPERS
Right.
risk. So it's something we have to continually look at. CalPERS, when they had the 21% return, the discount rate automatically lowered with the goal that would help the increase. The high investment return would help offset the higher contributions as it related to the lower discount rate. And if you look at over, and I don't have this data in front of me, but I can get you over, if you look at the CalPERS 5, 10, 15, 20-year rate, they are at or above that discount rate that they're currently at. And so it's something we have to just monitor and be aware of and take into account into our future financial planning.
Provided they deliver.
Yes.
Right, okay. So I see in the report, and my numbering is different because I'm operating off the computer. But a number of our funds or inflows seem to have significantly changed, like at 40%, the deferred inflow of resources and the capital grants and of both had major decreases. And I guess the capital grants is because of ARPA decrease, but deferred inflow of resources is down quite a bit. Is that a one-time or is it a trend? That's more my question on those.
Can you give me a page? I know you're working from a different numbering, but
If we look at the, I can pull it up myself. It's
6-page difference.
Yeah, well, it's more than that. It's 30. It's 35 on the if we look at the, that's the page number.
And this is the deferred inflows of resources?
Correct.
No, so page 20 is the statement of net position that shows the deferred, but are you looking at a comparison? That would probably be in the MD&A.
It's on page 8, I think. Yeah, page 8. Related to pensions, it's down 46%. It just jumped out at me as something I don't fully understand.
Would you like
And I
me
didn't get a
to-
chance to talk with Scott and Katie.
In the pension plan footnote in pension, note 9, it's page 63 of the ACFR. It shows the components of the different deferred inflows and outflows. So the deferred inflows, these are kind of actuarial changes. So so like for the miscellaneous plan, it's the differences between actual and expected experience. So again, this is what the actuarial reports. And then they have the change in the employer's proportion of, so this can change because the town of Moraga is small, they have less than 100 employees in the plan. They're part of a pool with several other entities. And so your proportion in that pool can change year to year, just depending on who retires, who gets added on, the different contributions that each entity is making. And so your proportion changes. So these deferred inflows and outflows are meant to kind of smooth so that your liability isn't going like a roller coaster. Of course, it didn't work a couple years ago, but this is meant to kind of hit more of your P&L versus your balance sheet. These deferred inflows and outflows, but so the significant changes in there are related to that proportionate share from what I'm seeing on the deferred inflows of resources tables.
Right. Okay, good. Then on page, the table, the one, and these two charts are wonderful, but page 15, it shows a sales tax revenue of about $1.3 million. That's not the Measure K. That's obviously that's not included, right?
Correct.
So
That's
Measure K is reflected where?
Measure K is in its own separate fund, and so it's not reflected in these charts, which are
Okay.
primarily about the general purpose. Measure K, we actually get about double our Bradley burn, so we got about 2.6 million
Right.
this last fiscal
Yeah,
year in Bradley
between
burn.
the two of them, it's about 3.9.
Correct.
Which is good.
Correct.
And then finally, when I look at the sales tax chart, I don't see companies like Amazon listed. Is that again the same thing? It's covered under Measure K?
Yes, so online sales of our Bradley burn are pooled with throughout the county, and then we get our proportionate share of brick and mortar sales for our Bradley burns. The transaction in use, so tax Measure K, that we get directly for the Measure K for those sales. So you order something on Amazon online. Amazon's probably not the best example. There's a lot of qualifiers, but then that is reflected in our Measure K tax, and we see that directly. And so if we look at our, and so the businesses referenced in our top sales tax producers are based
Right.
on the Bradley burn.
It's restricted to Bradley burn.
Yes.
Okay.
But and there's a rule when you're reporting sales tax data to report on a group. You have to have five businesses in an industry group. And then you also have to, how you report sales tax, but we can look at our pool and see if that's something that we can
Now,
incorporate.
do we, on Measure K funds received, the revenue for Measure K, do we have that granularity to be able to differentiate different sources? It'd be kind of interesting to see.
I have a question related to this.
Okay.
How much of that $2.6 million from Measure K is because of auto sales? Because when a person or purchases an auto anywhere in the state, the extra 1% gets added and that comes back to us. And my guess is that's a fairly significant number. The other difference is the online sales, Amazon et al.
Right.
But it would be nice to know how much of that's auto, and it could very well be a pretty significant number. And you can report that, I think, because there's a whole bunch of dealerships involved.
Well, if it's easy, I'd support finding out that information. If it's really, I'm loath to add more work to staff if it's onerous or if it's significant.
Okay.
Hi, Amy.
We'll take a look at that. and
Only if
we'll
it's
bring it back.
easy.
Yes. No, I know Avenue can still help support us with that.
That's it.
Yeah, I do have a question. You know, I've read the description many times of this Bradley Burns. I have no idea what that means. Can you explain that to me?
It's of the statewide sales tax, which is 7.25%.
But ours is like 9 something.
Yeah.
We get right, but then every jurisdiction, a lot of jurisdictions have additional district tax or sales transactions and use tax on top of it, which is part of Moraga's Measure K. The county also has an escalator, I think, for Measure X on there. So in Measure J through the CCTA. So there's that. What we pay at the cash register is a compilation of all that. But the base rate is, I think, 7.25%, and that's the state. And then we get a 1% of that 7.25. So that's what the Bradley Burns is, and that is in the California government code and defines of what it is and how and what jurisdictions get. So
Thank you.
yeah.
It's the basic 1%. For up until like 1990 or so, all the cities got 1%. And in some counties like ours, the county takes a sliver for administrative, so it's really like 0.95 or something. But Bradley Burns 1%, and the Measure K is another 1%. We get a little bit more. Does that make sense? So,
Finally,
yeah,
thank you.
just think of it as in total we get 2%, but 1% is Bradley Burns. It goes through the county pool. If it's an online purchase, but we get our share back.
The 1% is cash registers located in Moraga. So actual sales in Moraga of all the various stores and whatever, that goes into this Bradley, and we get 1% of all the sales. So if we get $1.3 million, that would suggest that the sales are 100 times in Moraga.
Yeah.
This other stuff is online and cars and whatever, which is a pretty big number. It's almost doubles the.
Yes.
And the Bradley and Burns, those were the either assembly members or senators from 80 years ago whose names were associated with the legislation.
Thank you. You know, I have tried to scramble that in my brain so many times, and at last, better late than never. Thank you.
Do you have any questions?
No, thank you.
I don't have very many. You mentioned the major and minor or lesser accounts. How is, what accounts are which, or how do we know that?
So in page 28, in our statement of government of revenues, expenditures, and changes in fund balance, it lists out all of our governmental funds. And so then that's where, as a government entity as a whole, we list all of the funds that are classified as major, and anything that's not major is combined into the other governmental funds. And so you will see, as with the new GASB pronouncement, we have our general fund, which is actually a combination of our general purpose, Palos, and our deposits.
And general fund is always a major fund.
Oh, yes, it could not be. Our Measure K is a major fund. The American Rescue Plan Act Fund is no longer a major fund because those revenues are received and that activity is winding down. Construction is in progress is where we record all of our activity related to our ongoing capital projects. So that's a major fund. And then we had the other capital funds listed as major in prior years, which was a combination of 7-ish funds that we've moved to our special revenue funds. We felt it better reflected the activity in those funds. And then our debt service fund is also a major fund. So that's where it lists out what we classify as major and non-major. And then the other governmental funds, you can see the compilation of that and all of the fund detail in the supplemental information.
So everything else is, it's basically general fund K, Measure K, construction in progress and debt service, and everything else is,
Correct.
okay. Another question, which just, well, maybe it's not, yeah. Do we retire assets? In other words, what happens is when the town was incorporated, we got a whole bunch of roads that had been put in by developers in the county, and those went into our assets. As we've gone along, we put layers on top of it, we tear them out, we replace bridges over on the canyon, et cetera. And I'm not sure, in the past, we never went back and said, you know, that asset from 30 or 40 years ago really ought to just be pulled out and we shouldn't just keep adding. What's the policy and what are we doing on that?
So note 5, which is on page 55, is our capital asset schedule. And so that's where we report all of our capital assets, which includes our infrastructure. We do have a capitalization policy, which sets the threshold of which we decide to capitalize something. And then we do depreciate all of our assets. And so we have general useful life set out in our capitalization process as well. But with something like a road, it depreciates over time. But then when we have a project to majorly reconstruct all of the streets, well, then we are adding value back to the asset. And so that becomes an addition once that project is useful. So
That project starts and depreciates. But at some point in terms of the gross numbers, a company would end up, if it retires a particular asset, it will pull the original amount and whatever the depreciation's out of their numbers. And I'm not sure for many years we were not doing that, and I'm not sure.
we, I don't know if we have, I would have to look at the specific capital asset detail about if there were specific things that are retired.
Maybe I don't want an answer, but maybe we should go back and look, and the auditors need to weigh in on how should this be done under GASB.
I mean, it's not often, I mean, usually assets are taken up, especially like if it's infrastructural assets, it's usually if there's an impairment is when it would be removed. It's not often that they just kind of go.
So the question would be, is the original Canyon Road Bridge gone?
As
Yeah,
an
we-
asset.
Or is it still there? It would be
No,
fully appreciated by.
Well,
The current value would be reflected.
yes, it would be, because it depends also whether it's a repair of the bridge or a complete replacement, right? So there's a few different factors to look at. But yeah, definitely something we could look at.
The permanent assets would be removed if you de-annex or annex, because it would go to somebody else's balance sheet.
Yeah, but Canyon Bridge, which was on there at some really small number because it came when the town was incorporated. When we replaced it, it should have come out off the list, and my guess is, you need to look at that and think a little bit about it.
I take it that when we replace police cars, the old car is taken off and
Yes,
put the new
the-
car on. I
Yes.
suspect it's something analogous was done for the bridge. I would.
It would be, then, yeah, rolling stock, it's surplused out, and then a new asset comes in. So the bridge, the old value would go out, and the new,
If we're doing that, that's fine. At one point, we were not doing that, and that's, I guess, why I bring it up. And another question, what sort of rate of return do we get on the $22 million or something that,
So we have, currently we're getting, not including the pension trust, about 5% through our funds in the money market account and through our funds in LAIF, and those are our current two interest earnings accounts. And our pension trust, it is growing in value, but I don't have the calculation of the rate of return at this moment.
so at some point, should we be looking to invest those things in something more than just LAIF and a bank?
That is on my work plan, and we looking at balancing cash flow and our kind of base investments. So it is something that we are looking into over the next year.
That should still be on your plan, I think.
Yes, it is.
Other than that, I just wanted to say thanks to the staff and to the auditors for getting this all done. I remember years when down in Moraga, we were sitting in March and April talking about the annual audit and whatever, to get it done before the end of the year, and in fact, to get it done pretty much by the end of November. I go to council in a week or two, I assume, or a couple, someplace along here. But basically, by the end of the year is excellent, and it's due to the work by the accounting staff and the auditors. So thank you.
Well, and Chair, if I may, I would really like to thank Sylvia Wells, who does a lot of the heavy lifting and coordinating with Vicki and her team, as well as Donna Sullivan and Stephen Thomason on my staff, who have just done a tremendous job and make me look really good up here, along with our auditor. So thank you.
Yeah, if I can just add, as reflected in the documentation, they've received the GFOA Certificate of Achievement for Excellence in Finance Reporting 11 years straight, with expectation of doing it again. And certainly I found that going through the report that it was well organized, generally easy, some by the nature of it, some aspects that I find to be somewhat oblique, but that's more a reflection on me. So I echo the Chair's comments and thank you very, very much, all of you. Really.
I'd like to chime in too. As an artist, this is not something that I would deal with in my normal life at the easel. So making it clear and Thank you, Donna. So I'll repeat, as an artist, this is not something that I would traditionally look at, as I'm working at my easel. So being able to read this and understand it, as a layperson, you've done it. So congratulations. I don't think that that's an easy thing to make me understand, and you did it. So congratulations. Thank you very much.
Okay.
With that, we don't need to do anything on this other than just
Provide your feedback, and it's an opportunity for us to answer your questions. So thank you.
yes.
I just want to say something maybe for Amy's benefit, because you're still relatively new and trying to figure out how local government budgets and finance work. It's very confusing compared to the private sector, but this part of the puzzle with our outside auditors that come in, we give you the financial report for the year that ended the previous fiscal year, which is July 1, 2023 to June 30th, 2024. This is the snapshot, how did we do, right? We have the estimated revenues, the projected expenditures, right? Well, how did we do? That's what this is. Council now, staff, here we are in December. We're getting ready for the next budget cycle, which will be July 1, 2025, 2 one-year cycles all the way to 2027. So we'll be working on that, and the budget is the anticipated spending plan for that cycle. Right? So all these pieces are important, and the staff here are always working on different components of it.
Yeah, thank you.
So that's where we are with this.
So I think we're done with that item. The next item would be on the agenda is to establish an AFC meeting. Traditionally, we kind of wait until you think it's time to talk about probably mid-years.
Yes, so beginning of probably February or early March, we'll be reaching out for come with our mid-year.
Thank you, Vicki.
And then this will be an exciting time for AFC next spring as we develop our next biennial budget. So,
Okay, we will wait for that. Anything else? Do I have a motion to adjourn?
I have one question you probably answered when I wasn't here, and I completely apologize. I didn't realize my schedule was going to turn out the way it did today. I'm sure you covered this already, but I was just wondering, the planning and permits, why did they come in so much lower than was estimated? Was there like some kind of thing that was budgeted that didn't happen, or?
can I ask for a page number?
Oh, sure, it's page 31.
Thank you. Yes. In terms of the expenditures or the revenues, the planning and permit revenue is. I'm sorry, revenue. Yeah. Okay.
Yes.
Thank you. It's based on permits and projects that are pooled, and so I think we've had some projects in the pipeline that are still in the pipeline, and so it's a little bit of an estimation game, and then also depending on how the time frame of projects and when we are able to collect the fees versus the ongoing work on there as well. So, and it's related to it's related to the various projects that it can be
Development projects. and
development
stuff.
projects or even residential permits, so, ADUs, so it's dependent on kind of those outside
Timing.
factors as well and
Yeah.
timing.
They'll
But
be
there's not-
higher in
okay.
the next fiscal year.
So there's not something big that got delayed that like is reflected here. It's more small, a lot of small things that just didn't happen in this year.
I want to be diplomatic here. The property owners slash developers are moving slower than perhaps many people would like to see them move. The projects they're moving along. The zoning is there. We have a certified housing element now. We have an updated general plan document. The zoning and land use opportunities are there for the property owners. They just need to move forward.
Okay, thank you.
Do I have a motion to adjourn?
So moved.
Second?
Adjourn. All in favor?
Aye.
Bye.
Aye.